Hi everyone. So another free-flowing video here, kind of similar to the previous video. Not very structured, but I will be bringing you through some numbers. Obviously, what you see up here is the financial model that I use to forecast essentially the income statement every quarter. Um, I share this with my subscribers on X at the end of every month, essentially tracking throughout the quarter based on my forecast for deliveries. And of course, now we have the final delivery number for the quarter, so we have the actual final number. And I'll be going through, walking you through sort of line by line on the income statement. This is what the income statement looks like here. In white is the forecast for this quarter. We have in green Q3 of 2025, so last quarter, just a comparison. And in red, we have the same quarter this time last year. So I'm going to make this a little bit bigger, and essentially we'll be going through the different numbers line by line. On the left here, just before I do that, is essentially the model that I use to forecast, essentially the automotive revenue number. So I have here all the models by all the factories, the different prices, trim mix assumptions, lease rate, etc. I have the split by region, by for example, Shanghai vehicles are manufactured. They're also shipped to other countries. Obviously, those other countries have different prices. So I try and capture all of that, and I also capture FSD take rate, deferred revenue, etc. And that feeds into my automotive sales line, which is the top number in the income statement, the biggest number as well, the most important number to forecast correctly because it's the most obviously the highest number here, right? So going down, I'll be going through sort of each line row by row, but I do want to sort of just focus on this for now. So I'll just hide all of this here so we're not distracted by it, and we'll just focus on this. Okay, so we know the delivery number. The first thing I like to do is look at the average selling price and seeing sort of what direction this number is trending and why. It kind of gives a sense of, and obviously my model feeds this number, which, and this is just essentially automotive sales divided by total number of vehicles. But the directionality of this number quarter over quarter, year over year, can be important. Looking at what's changed in the quarter versus the previous quarter in terms of the vehicles, that if there are any new vehicle launches, promotional depth, etc., that all factors into this. And I try and track this very closely, and I try and use that to sort of guide my assumptions. So, from an average selling price perspective, looking quickly here, we see that there's a decline, right, quarter over quarter. It's about 3%. Um, what's driving this? Essentially, there was much bigger discounting depth and promotional depth in the US in Q4 of this year versus Q3 of last quarter, or sorry, Q3 of 2025, which was last quarter. That's because, and you guys, I'm sure you guys all know this, but Q3 25 is when the IRA tax credit expired in the US, and so there was a lot of incentive for buyers to place their order in Q3, which meant demand for Tesla vehicles in the US was very high, and they didn't need to discount those vehicles as much. But in Q4, we saw kind of more of a traditional approach by Tesla throughout the quarter, increasing the amount of discount depth, financing rates got better, etc. as the quarter progressed. So when Tesla offers better financing, that actually comes off of the price. That's how it's accounted for, and so by definition, the average selling price will be lower. The other big factor in Q4 compared to Q3, if you're looking again quarter over quarter, is the percentage of vehicles that were delivered in China versus rest of the world. Because the the Chinese market has the lowest prices in the world, if there's a greater percentage of vehicles delivered in China relative to the rest of the world on a quarter over quarter basis, it's going to drive price down. I have a graph here that I want to show you guys. And the same thing is true for cost. So I'll get to cost next, but focusing on price, uh, ASP is this dark red line here. The bars essentially is the percentage of deliveries in China. So this is the data that's feeding this sort of chart here is this table. And here we have the deliveries of domestic China deliveries. So you'll see Q4 25 was a very strong quarter, almost their best quarter ever, slightly below Q4 of last year. But I mean, neck and neck essentially. But last quarter, they delivered almost 500,000 vehicles. This quarter, they delivered 420,000 vehicles roughly. So percentage of vehicles from China, you see it on the graph here, much higher in Q4 25 than Q4 24 or any other quarter before that. And what we've seen in previous quarters, and I have these two rectangles, green and red, when the percentage of Chinese vehicles delivered increases, we tend to see a decrease in price. Again, for the reason that I mentioned before, vehicles that are sold in China are less expensive, right? So as this bar goes up, this line goes down. We see that here consistently. And then as the bar decreases, so as the rest of world vehicle as a proportion of total deliveries increases, if they sell more vehicles in the US or in Europe, for example, this bar will come down and subsequently ASP will go up. So there is a correlation here between the number of vehicles sold in China and price. The same correlation is true for cost, right? So not only are the vehicles sold in China the least expensive in the world, they're also manufactured in China, which is Tesla's lowest cost factory. So for the exact same reason, as the number of vehicles sold in China from China's production increases, the costs are going to decrease, and as that sort of goes back up, then costs will also increase. So these two lines where you see they go in the same direction. They're perfectly correlated here. Um, so when we see this big bar here going in Q4, huge number of the total percentage of vehicles were sold in China this quarter, almost half. Again, much higher than every other quarter. What we would expect to see is we would expect to see the ASP to come down, and we would expect to see the cost to come down on a quarter-to-quarter basis. So go back to my forecast, and that's kind of what we see. We see ASP is coming down versus last quarter, right? 3%, and cost is also coming down versus last quarter. So I think directionally, this is correct. Now the question becomes, how accurate is that? And that's where the sort of the magic happens, right? That's where we have to rely on our model, and hopefully we're forecasting that as accurately as possible. But definitely we should expect to see this sort of dynamic play out this quarter. I'll get to the cost assumptions next, but just finishing on price. So what's driving price down? So we talked about discounting depth. We talked about the Chinese that graph I just showed you right now on the Chinese deliveries. We also had the launch of the Model 3, Model Y standard vehicles, which are obviously priced at a lower starting point. So the more Tesla sells of those vehicles, the less, the lower ASP will be. But I don't think those vehicles had a big role to play in Q4 because I don't think they sold particularly well. So because they didn't sell in significant volumes, I don't think they're going to be playing much of a role here at driving price down. Now, every quarter there's catalysts that push price and costs up and down. So I want to cover both. Um, there are sort of negative ASP catalysts that sort of drive cost up or price up this quarter, which obviously Tesla wants to increase price because uh, better likelihood that there's a more profitable vehicle at the end of the day if they're selling at a higher price. But so what are the things that are pushing price up? The big one is, again, going back to China, two big changes in their vehicle lineup on a quarter-over-quarter basis and on a year-over-year basis. We'll talk about year-over-year next, but quarter-over-quarter, we have a full quarter of Model Y L sales. So Model Y L carries a $9,000 US premium against the base Model Y in China. And it launched deliveries only started in September of Q3. So Q3 only had essentially 1 month of Model Y L. Q4 had a full 3 months. So on a quarter-over-quarter basis, um, the mix of Model Y sales, Model Y L sales in Q4 is higher than Q3, and that's pushing price up. Again, year over year, there was no Model Y L in 2024. So again, same effect. We're having a higher net price, average price in China due to the Model Y L. There's another model that is not spoken about as much, but I think is as important as the Model Y L is for Tesla's Chinese portfolio of Model Y, and that's the Model Y Plus, sort of the long-range rear-wheel drive Model Y that was launched in November. Um, this vehicle is not quite as doesn't have quite as big of a price gap with the base Model Y. It's only $3,000 US more expensive, but because it's not such a big gap, that's going to encourage a lot of consumers to really upsell or premiumize to stretch for that additional range. I think it's a very good value proposition, and I think it's going to be an important player in the overall picture here for Tesla moving forward. It only launched in November, so Tesla will continue to benefit on a quarter-over-quarter basis in Q1. But again, year over year, it wasn't there last year either. So Model Y L, Model Y Plus, um, those are important factors for Tesla, driving price up. The other factor, maybe not a huge role because it kind of launched late in the quarter. Um, Model Y Performance, obviously, Model Y Performance carries a higher price than the other trims in the portfolio. So it launched in Europe, and I think they managed to get some deliveries into the US, but not much. So that the Model Y Performance doesn't play a bigger role in Q1, maybe Q2, as production increases, but it's still a factor in Q4. And then the other change that's pushing price up relative to last quarter is the new pricing structure for Model S, Model X. Now that there's the Lux package included, they just have a higher starting price. So overall volume of, if you combine SX and Cybertruck, was down sequentially. Overall volume came down, but what they sold of those vehicles were sold at a higher price. So that's pushing average selling price up. If you're comparing on a year-over-year basis, so I've basically been speaking mostly quarter to quarter, but looking at year over year, again, it's actually an increase. It's actually an increase of about 5% on a year-over-year basis. I think the biggest driver for this is really those changes that we talked about in China, um, and just overall sort of, portfolio mix differences in my assumptions in Q4-25 versus Q4-24. So I did I did play around with the model mix to try and be more accurate on the forecast. But that's driving an increase. I think it makes sense given what we've seen in China, especially, and the high volume that those vehicles represent this quarter specifically. Now, looking at cost, so this is this row right here: automotive cost of revenue, automotive sales. So the two biggest numbers, right, in both of these, in the revenue bucket and the cost bucket, are these two. So that's why I like to start with these two, and then I'll go into the other buckets later: regulatory credit, energy services, etc. But automotive cost of sales, what's driving, and we see right away again the number is lower than Q3 of Q3 of this year, but slightly higher than Q4 of last year. And we talked about part of it. That's the Chinese effect here. We would expect costs to sort of fall quarter over quarter because we're seeing a huge percentage of vehicle deliveries that are sold in China, made in China. We would expect that number to come down. That's probably the biggest driver here. Um, Offsetting this, however, is lower overall production in Q4 versus Q3. Um, Lower production. So all things being equal, if production is lower, again, all things being equal, the average cost of whatever it is you're building will be higher, right? Because those fixed costs are amortized over a fewer number of units. Right? It's an accounting principle. But that's driving cost higher on quarter to quarter basis. So if we look again, quarter over quarter, we're seeing a decline. Year over year, we're seeing an increase. I mean, I think on the year over year basis, there's cost inflation that's probably being captured in here. This is potentially an area where maybe costs come in a little bit lower. And so what that means is that obviously, if you look at, I'm jumping down here to the margin, our automotive gross margin, which is a function of both automotive sales and automotive costs. If costs decline faster than my estimate, then the margin number will actually be higher. So right now, I'm currently forecasting quarter to quarter decrease in gross margin. I think this makes sense given, again, everything we talked about. But if I'm too conservative on the cost reduction, given the Chinese mix, then it's possible that this number isn't quite as low. It's possible that it's maybe even in line with last quarter. So that would be a positive for Tesla. But right now, I think the numbers kind of make sense as I have them here. All right, so we've covered automotive sales, automotive cost. We'll now jump into regulatory credits. So regulatory credits. Oh, before I do that, just a historical view of costs. Do I have a graph here? All right, so now we've covered automotive sales, automotive costs. Let's cover regulatory credits. So you'll see right off the top again, I'm forecasting 350 million Q4 2025. That's a sequential decrease versus last year, or versus last quarter, and a big decrease versus this time last year. Now, I have a chart here on regulatory credits. So regulatory credits, as you can see here, they've been declining sort of for 5 straight quarters, right? One, two, three, four, five. This would be my sixth straight quarter of declines ever since sort of the peak in Q2 2024. And the big driver behind this is the passage of the Big Beautiful Bill, which in mid 2025 eliminated penalties for automakers that failed to meet sort of the corporate average fleet economy standards set by NHTSA. So this essentially removed incentives for legacy manufacturers like GM, Ford, Stellantis to purchase credits from Tesla. Now, I think Q3, I mean, there was a bit of a decline, right? 417 from 439, but I think a lot of those automakers were kind of locked in at that point, and they had to sort of pay Tesla. They couldn't back out. But I think in Q4, we're going to be seeing sort of a big decline here. This is probably the first quarter where we're going to see the real effects of this regulation. And moving forward, if we look again at the yearly number here, we've seen regulatory credits sort of increasing every year. I don't have a 2025 number yet, but it's likely going to be a decline versus 24. And I don't think it's ever going to ever reach this level again. So we're going to start seeing these numbers sort of heading the other way for the first time, ever. So that's something I think we could look forward to. I think that's reasonable. Go back to my model here. Again, regulatory credits come at 100% margin, so I don't have any costs against that number. It's pure margin. It's pure gross profit for Tesla. So that number declining is not great, but obviously it's a small contributor of the overall revenue bucket, although it's a highly profitable one because it's 100% gross profit, gross profit margin. All right, so that's regulatory credit. We'll see how that looks. We'll adjust. The next bucket I want to cover is services and other. Services and other. So you see, it's again, not not that big, but not that small anymore. Bucket for Tesla. It's always been their smallest sort of bucket with their lowest margin, and this number tends to scale with deliveries quite nicely. So if you look historically, for example, Q4 to Q1 was a big drop in volume, right? So Q4, Tesla printed a $2.848 billion number here. And in Q1, when deliveries fell, it fell to 2.6. So sequentially, it dropped. Every other quarter since then, it's been increasing as volume has been increasing. And so I think, again, it makes sense to expect a sequential drop in this number in Q4-2025. For those of you who don't know, like this number essentially covers all of the non-automotive revenue that Tesla generates. So service, supercharging revenue, merchandise, any of that kind of stuff kind of just gets lumped in here. Anything that's not automotive, like selling a car or leasing a car or selling an energy product, falls into this bucket. So I'm assuming an 8% gross margin here. That's the gross margin. If you look at that, it's 8%, which I think is a little bit lower than last quarter. Last quarter was a record. I think they said um, it was like 10.5%. If I go back, yeah, last quarter was 10.5%. But historically, like if we go back all these different quarters, historically they tend to be in the single digit range. So 8% is actually quite high, I think, by historical standards. So I think it's a fair number, given that they came off a really strong 10.5 last quarter. It's still giving them credit maybe for some efficiency that they've sort of gathered. Either way, it's a small number, so it shouldn't affect the total gross profit number that much. Really, the big driver of this number is going to be energy and the vehicle number. The 14.5% here will be the biggest driver of that. So speaking of energy, we know that Tesla installed 14.2 gigawatt hours of battery storage in Q4. Um, my assumption here, my forecast is that ASP will continue to decline a little bit. ASP has been declining on energy. So I have an assumption that it'll decline sort of 5% from last quarter. I have a chart I can show you, sort of shows this. So here we have our ASP, right, by quarter per gigawatt hour. And then here we have our gross margin. So you see, despite the fact that ASP has been declining, like if you just draw a line through all of these bars, it's clearly going down. um, the gross margin number has been going up. So Tesla's been able to sort of cut costs faster than they've been able to actually reduce, faster than they've had the need to reduce price. And that speaks to the fact that there's been strong demand for energy in the market. So this trend is going to eventually stop. ASP is going to eventually stop sort of declining. Um, but due to the fact that a lot of this is being driven by Megapack, of course, and Megapack projects are recognized over a longer period of time. There was a period of about 8 months or so, almost a year and a half now, where Tesla sequentially cut Megapack prices. Those contracts are slowly sort of trickling through Tesla's operations, and eventually they'll reach a point where if Tesla keeps price steady, ASP should stop declining. It may even be this quarter. It's just been consistent over many quarters now where we have seen that decline. So I'm kind of taking a conservative approach, assuming that continues. But by that same token, I'm still assuming a healthy gross margin of about 30%. If you look at the gross margin number here, it's yeah. So I'll just do a quick formula. I'll show you guys. I don't have this built into my number right away, but yeah, it's a 30% gross margin. So last quarter they were around this here as well. Tesla's been able to maintain a very high gross margin on energy, despite the fact that the source for their batteries come from China, LFP batteries from CATL. They've been able to pass on the cost increase for those tariffs to the customers, and they've also been able to mitigate um, some of the impact of the tariffs by shipping directly from Mega Factory Shanghai and not going through the U.S. at all. So they've been very nimble and flexible, and I think they have a lot of power in the negotiation with their customers because the demand for battery storage is so high, and Tesla has a lot of expertise at these projects. And I think for the customer, they're generating so many cost savings by getting these batteries installed that even if the upfront installation cost is a little bit higher, then they're willing to pay for it. And Tesla's done a really good job at structuring their contracts so that they're able to sort of be agile with regulatory changes like the introduction of tariffs and being able to pass those costs on to the customer. So I'm assuming in this quarter they're going to maintain that. If they don't, if for whatever reason that changes, then there's risk in this number, this 30% number here. It's potentially going to be in the low 20s. So just to keep an eye on that. But I think otherwise we're sort of in good shape with energy. Total revenue, I'm at 24.4 billion. Total gross profit 4.1. So if I look at what this means in terms of a percentage, I'll just make my table a little bit ugly here, but worth looking at. So percentage wise, we're like at a 17% company gross profit, which compared to last quarter, a little bit lower, and but a little bit better than Q4 of last year. So sort of a mixed bag in terms of the picture there. But yeah, the next bucket we'll cover is operating expenses. So the two big buckets that we cover on operating expenses, R&D and SG&A. I have a really cool chart that tracks this. So historically, from 2017 onwards onto 2020, essentially 2022, Tesla was really doing a good job at reducing the ratio of operating expenses to overall revenue. Right? They were sort of expanding their sales faster than expanding their operating costs, and that drove a lot of profitability for them on the operating margin side. What's happened since 2022 essentially is a steady increase in this ratio. You see that the bars kind of stopped declining, they started increasing here. And we're seeing a big jump, Q1 to Q3 2025. And what's driving that is the blue line. It's R&D. SG&A costs are relatively flat as a percentage of sales. It's really these R&D costs that are increasing. And going back to my forecast for Q4, I'm expecting sort of more of the same here. My R&D is a sequential increase versus last quarter, and if you look at the year-over-year comparison, it's quite big. I mean, last quarter there are 1.6, so there's already a big increase here, and I'm expecting it to continue. What's driving this is really the all of the investments Tesla has made into their data centers, their training compute for FSD, um, everything that they're doing with respect to FSD, essentially robotaxi. They purchased a ton of equipment, a ton of capital equipment to train, and all of this equipment essentially they're starting to pay for depreciation costs against it. And so because of that, and they're continuing to buy more. So this R&D line here is kind of reached escape velocity a little bit. It's going to keep increasing, um, unless Tesla decides to slow down, which I don't think they're going to slow down. And really, until Tesla starts to generate incremental revenue that's being driven by this R&D and spend, then the operating margin will continue to be under pressure by that. SG&A is not quite the same. Again, going back to that chart, it's relatively flat. It's kind of slowly trending upwards, but they've done a pretty good job at kind of containing SG&A cost despite everything. They've done this through restructurings and that sort of stuff. Um, but it's really the R&D line that's going to kind of keep increasing. So I don't expect this to slow down anytime soon. That's why my forecast is showing growth again in Q4. Again, moderate sort of quarter-to-quarter growth on SG&A as well. The other thing I find interesting is that despite the fact that Tesla sort of done some restructurings and they had some restructuring expenses even. I think last quarter they restructured the Dojo team, but there were maybe 2 quarters before that. I think there was another big restructuring. Um, we're still seeing SG&A costs sort of increase on a year-over-year basis. So I think a lot of this is sort of just inflation, but that's why Tesla kind of always needs to stay on top of their employee overall employee headcount and structure, and they do a good job at that, generally speaking. But what this means is that operating expenses as a percentage of total revenue are going to keep sort of increasing. And I don't have a line here for operating margin. I should probably do that. Um, but operating, this should be on this side here. So operating income divided by revenue. This is your operating margin. And so 3.6% this quarter, again, compared to last quarter, much lower and lower still compared to the previous year. So that's not going in the right direction. And I don't think it's gonna turn around necessarily until again Tesla starts to generate significant sales from everything that they're investing in R&D, which is in large part FSD. And so I think that's coming in the future, but it's maybe happening a bit slower than some people had expected it to. The next lines are non-operating income. So we have, Tesla has a lot of money in the bank, right? Some investments, short-term investments, etc. So they're generating interest income. They also have some debt, so they're generating some, um, some interest debt here. What's the word I'm looking for? I forget. It's late at night and I'm tired. But essentially, the net number here is $410 million. So slightly increased over last year, last quarter. Sorry. This is a bit of an outlier. This was when Tesla recognized a lot of Bitcoin gains. So it's not really a relevant comparison, but it is what it is. The other big sort of difference I want to say year over year is the tax rate. So Tesla's been sort of in the mid 20s all of 2025, and in 2024 they're still sort of in the mid teens. So that just means that obviously this affects their net income number more than anything else. But that's the reality. Last quarter they're at 29. So I'm going back to 23, which is where they were I think in Q2. Yeah, they're 23 in Q2. We'll see. What this means if you sort of drill all the way down, and I'm gonna ignore sort of the high level number here and just go to the adjusted earnings per share. That's at 43 cents. Last quarter was 50 cents. Again, they delivered significantly fewer vehicles, so I don't think that's a surprise. Energy was grew, but you can't offset this sort of vehicle delivery loss. And then same thing versus last year, and so and last year they were helped by that Bitcoin impairment as well, or not impairment, Bitcoin gain as well. So 43 cents. Yahoo's currently forecasting, the consensus analysis is currently 45 cents with a low of 30 cents and a high of 56. I think 45. I'm at 40. What was I? 43. When I shared this with my subscribers, um, I was at 42 cents. So I've made a few changes that haven't really changed the story all that much. Directionally, everything's the same. but uh, yeah, 43 cents. So pretty much in line with Wall Street, I would say, a little bit below. My revenue number is at 24.4, right? 24,425. The average consensus revenue number is 24.7. So I'm a little, again, a little below. I don't really think this is going to matter all that much. Tesla stock, especially if you're thinking about trading, the stock tends to react to um, guidance a lot more than it does to the actual results. Yeah, so there's been quarters where I've been sort of dead on the forecast and the stock's gone, and maybe dead on with a miss and the stock's gone the other way, and or dead on with a beat and the stock's also gone down. So you never really know. That's what makes that get fun. But yeah, historically, and if you look here, Tesla has sort of a history here of missing. Sometimes not by much, but they have missed every quarter for the past four. So I'm expecting another miss this quarter, but overall, I think quarter wasn't terrible. Given everything that happened, given the pull forward effect that we saw in Q3 from the U.S. market, China really performed exceptionally well. Uh, Without China, it would have been probably a rough quarter, certainly. Um, we'll see how Q1 fares. I think we're going to get some data from Europe and from China in the next coming week or two. They'll be able to see. I'm expecting the U.S. market to sort of bounce back. They've been sort of more aggressive with their promotional activity quite early in the quarter as well, particularly on the new sort of standard trims. We'll see how popular those vehicles are. They certainly have a more appealing price point at this point, so we'll see where that goes. But overall summary, I guess 43 cents a share versus expectations of 45 cents. That's a decline, sequentially decline versus the previous year. And as I do on every earnings call, I'll definitely be following that call live. Now that I have access to a YouTube channel, I may try and do something creative around there. I'm not sure. I'm still kind of figuring it all out. But I do hope you find this video helpful. Again, if you do like this type of content and you want to track Tesla's results throughout the quarter, I share this type of analysis with my subscribers on X at the end of every month, tracking the previous month throughout the quarter, and I regularly update them on my delivery forecast and as well as the income statement. So I want to thank those of you who are my X subscribers who are, if you're listening to this, appreciate you. And for anyone else who's interested or you want to just chat, feel free to reach out to me on X. Wish you all a great day, great evening. It's 11:57 p.m. Here right now, so I'm probably going to go to bed relatively soon. But I want to wish you all the best. Thanks very much.